Have you ever paused to wonder if there's like a deeper rhythm to the seemingly unpredictable world of financial markets? Perhaps a hidden geometry, or ancient mathematical secrets quietly guiding the rise and fall of prices, almost like a cosmic dance? It's a captivating thought, isn't it, to imagine that beneath the daily chaos, there might actually be an underlying order, a discernible pattern that could offer an edge. Today, we are embarking on a profound deep dive into the world of a truly legendary figure in finance, a man who not only claimed to have found these very secrets, but really dedicated his life to uncovering them. William Delbert Gann. Our journey today is inspired in part by the W.D. Gann Methods Knowledge series by Market Geometry, spearheaded by Prateem Tungare. This series, well, it promises to break down Gann's most powerful techniques, peeling back the layers to reveal the hidden geometry, the intricate mathematics, and even the astronomical and astrological principles he believed were fundamental to market cycles. And yes, for those eager to explore further, you can access these insights through the Market Geometry app.
Yeah, and our mission today is really to go far beyond just the mystique that surrounds Gann. We want to understand not just what Gann proposed in his, frankly, groundbreaking theories, but why his ideas continue to fascinate and, let's be honest, often fiercely divide opinions across the financial world. And crucially, we'll also try to extract the surprisingly practical, timeless lessons and rules that we can draw from his extensive body of work. Lessons that remain profoundly relevant even in today's high-speed markets. Gann was, without a doubt, a visionary, and his influence, well, it echoes loudly even today.
Absolutely. So whether you're a seasoned trader constantly seeking that elusive edge, or maybe you're just a curious observer fascinated by the profound intersection of history, ancient wisdom, and modern finance, or simply someone who loves uncovering those aha moments that kind of shift your perspective, this deep dive offers an incredible shortcut. It's your direct route to understanding a truly unique and, let's face it, often enigmatic mind in market analysis. So buckle up, get ready to have your perspective on markets and perhaps even on life's own inherent rhythms profoundly shifted.
The man behind the mystique, William Delbert. Gann's life and influences.
Okay, let's unpack this fascinating narrative. Who was W.D. Gann, the man whose methods, even decades after his passing, are still being meticulously explored and even integrated into modern platforms like the Market Geometry app? It's a story that actually begins quite far from the bustling, high-stakes trading floors of New York. William Delbert Gann was born June 6, 1878, in the quiet, rural town of Lufkin, Texas. You have to imagine a sprawling family, 11 children in total, with William being the eldest. His father, Samuel Houston Gann, was a cotton farmer and also a teacher, a man of both practicality and intellect, it seems, while his mother was Susan Rebecca Gann. Now, this upbringing was deeply rooted in a devout Methodist family, and this religious foundation had a truly profound, formative impact on young William. He literally learned to read using the Bible, and it was within that sacred text that he came to believe he found hidden cycles, universal truth, and even mathematical proportions that would later inform the very core of his market theories. It's quite remarkable, isn't it, how such a childhood exposure to a religious text could shape a financier's entire worldview and lead him to search for divine order in something as, well, seemingly chaotic as the stock market. Interestingly, he had limited formal education. He chose to leave school at 16, driven by a clear desire to avoid the life of farming and to forge a completely different intellectual path for himself. So instead of turning furrows in the Texan soil, Gann turned pages. He became, by all accounts, a relentless, self-taught seeker of ancient knowledge. His dedication to self-education in fields as diverse as mathematics, classical astronomy, and ancient history was truly extraordinary. He delved deeply into Greek and Egyptian cultures, immersing himself in their philosophies and architectural principles. It's widely speculated by those who studied his work that this deep immersion significantly contributed to his development of geometric trading methods as he sought to apply ancient symmetries to modern price charts. It makes you wonder what profound hidden patterns he believed he was unearthing from these ancient civilizations that he felt translated directly to the dynamic movements of financial markets. And there's another fascinating, and for some, highly significant piece to his biography. Gann was a 33rd degree Freemason of the Scottish Rite Order. Now, for many of his followers, this affiliation is directly linked to his unique knowledge of ancient mathematics, esoteric principles, and the understanding of universal laws that he so rigorously applied to finance. It's believed that Freemasonry introduced him to certain hermetic traditions and mathematical concepts that aren't typically taught in, conventional academic settings.
What's truly fascinating here, I think, is how Gann's entire background, particularly his religious upbringing, his relentless self-study, and his engagement with esoteric traditions, profoundly shaped his approach to markets. He wasn't simply looking at charts or economic indicators in the conventional sense, as most analysts did and frankly still do. Instead, he was searching for fundamental, universal truths that he believed were deeply embedded in the very fabric of time and numbers. He saw these as principles that govern not just the natural world and celestial mechanics, but also human behavior, and, as a direct consequence, market movements. He wasn't content with just superficial analysis. He sought a grander underlying framework, a universal law, or cosmic blueprint, if you will, that he felt could explain and even predict market action, rather than just relying on standard technical indicators or economic models. This holistic view truly set him apart.
Right? Seeking the why behind the what. And it wasn't long before this self-taught scholar, steeped in ancient wisdom, made his foray into the fast-paced, unpredictable financial world. In 1902, at the relatively young age of 24, Gann made his very first commodity trade, which happened to be in cotton. And this wasn't just a random choice, it was, in a sense, a profound full circle moment, connecting back directly to his childhood spent on a cotton farm in Lufkin, Texas, the very life and industry he was determined to escape. This cotton trade marked the official pivotal start of his finance career, a shift that would ultimately lead him to become one of the most talked about, revered, and let's face it, often controversial figures in the entire history of market analysis and trading. So here's where it gets really interesting. How did this truly unique and fascinating background, his deep study of the Bible, his immersion in ancient cultures, his affiliation with Freemasonry, and that very first cotton trade, how did that translate into the specific, often mysterious, and certainly groundbreaking methods he became famous for? It's not exactly a simple leap, is it?
That's precisely the leap that makes Gann so unique and, frankly, so controversial. He wasn't just incrementally evolving conventional market thinking. He was, constructing an entirely different framework, believing that deeper universal laws were fundamentally at play.
Decoding Gann's methods, a fusion of disciplines.
Okay, so when we talk about Gann's methods, we inevitably hear terms like Gann angles and master charts. These terms immediately evoke a sense of almost mathematical precision, but also coupled with a definite air of mystique. So what exactly are these tools, and what's the underlying philosophy that ties them all together into a cohesive system? Well, at the absolute core of Gann's technical analysis methods are what he termed Gann angles. These are widely recognized as a foundational cornerstone of his work and are still used by many analysts today, although, with varying degrees of success and interpretation. Essentially, these angles are drawn from significant price points on chart, like major highs or lows, and they represent a very specific, proportional relationship between price movement and the passage of time. They're not just arbitrary lines on a graph. They're designed to determine critical support and resistance lines, projecting where prices might find floors or ceilings in the future based on their past movements relative to time. The profound idea here is that markets, like natural phenomena, move in definable geometric angles, and by accurately identifying and drawing these, one could, in theory, predict future trends, turning points, and even price targets. For example, a 1-by-1 angle, or a 45-degree angle, represents 1 unit of price movement for every 1 unit of time, and Gann believed this was often a key indicator of a strong, stable trend.
And it goes far beyond just simple angles, really. Gann developed what he collectively called master charts. Now, this isn't a single chart, but rather a sophisticated suite of unique geometric tools meticulously designed to uncover the deeper dynamics of market movements. For instance, there's the incredibly intriguing spiral chart, often referred to as the square of 9. Imagine a spiral of numbers, typically starting from the center and spiraling outwards, where each number represents a price or maybe a time unit. Gann used this tool to find profound price and time relationships, believing that certain numbers or angular positions on this spiral corresponded directly to significant market turning points or reversals. The conceptual insight here is that if a significant market high or low occurred on a specific number on this spiral, the next major turning point might be found on numbers that were a certain fixed angular distance away, like 90, 180, 270, or 360 degrees, revealing a kind of numeric and geometric harmony in price movements that defied conventional linear logic. He saw these as vibrational numbers, essentially.
So it's not simply about identifying a trend. It's about discerning a harmonic structure, almost like music, beneath the surface.
Precisely. And he also utilized the hexagon chart, another intricate geometric tool. This chart, sometimes referred to as the square of 6, is based on the number 6 and its multiples. Similarly, it helped him analyze market movements by correlating price and time across specific numerical points within its hexagonal structure. He likely used it to identify cyclical patterns tied to these specific numbers or their angular relationships, perhaps resonating with different, let's say, vibrational frequencies than the square of 9. Then there's the circle of 360. As the name suggests, this method often involves a full circle 360 degrees. Gann used it to identify significant market cycles and reversals, frequently tying these to specific degrees within that circle. The idea is that just as planets move through specific degrees in their celestial orbits, so too do market prices move through cyclical degrees, indicating moments of change, often marking major highs or lows when certain angular relationships or vibrational numbers are hit. These are definitely not simple tools. They require a deep understanding of his underlying principles and, frankly, a belief in the inherent order of the universe he was trying to tap into.
So it's clear this isn't just drawing lines on a chart. There's a much deeper philosophical and arguably even spiritual foundation at play here. It sounds almost like he was trying to find the music of the markets or something like that.
Exactly. The truly esoteric foundation of Gann's forecasting methods is absolutely crucial to understanding his entire approach. He wasn't simply looking at historical prices and volumes, which is, the purview of traditional technical analysis. Instead, he purportedly drew from a unique and complex blend of geometry, classical astronomy, the principles of astrology, meticulous time cycle analysis, and ancient mathematics. He firmly believed that the universe operates on fundamental, immutable laws, laws of vibration and harmony, and that these laws, expressed through numbers, time, and celestial movements, also govern the ebb and flow of financial markets. He saw the market not as a random walk, but as a direct reflection of universal order, a manifestation of underlying cosmic principles, rather than just human emotion or simple economic fundamentals. He was trying to discover the natural law behind price movements. And if we connect this to the bigger picture, Gann wasn't just a technical analyst in the modern sense of the word, not at all. He was attempting to synthesize disparate fields from the celestial sphere to ancient historical patterns, from profound mathematical theorems to observe market movements into a grand unified theory of market behavior. This raises an incredibly important question for us and for anyone studying his work. Is the market truly governed by such universal, perhaps even cosmic principles? Or was Gann discerning patterns that, while intricate and compelling, were ultimately coincidental, or maybe even a reflection of collective human psychology interacting with these very patterns he observed and believed in? It's a debate that has raged for decades and continues to this day, with fervent believers on one side and, well, adamant skeptics on the other.
And that takes us right to the heart of the matter, the sharply divided opinions on Gunn's work. You're absolutely right. On one hand, you have fervent believers who attest to the almost uncanny power of his methods and their seemingly accurate predictions, sometimes with almost religious devotion. They point to historical examples where his techniques, in their hands, have appeared to pinpoint major market turns. On the other hand, you have seasoned skeptics, often from more conventional financial backgrounds, who view his methods as too complex, too esoteric, or simply lacking clear, consistently replicable instructions. They struggle to find empirical, repeatable evidence outside of anecdotal success stories. The division exists precisely because of this perceived complexity, the heavy reliance on non-traditional analytical fields like astrology and ancient mathematics, and the fact that some of his writings were intentionally allegorical or coded, making them incredibly difficult for the average person to decipher and apply directly without significant, almost lifelong study. It's definitely not like following a simple moving average crossover or reading a basic balance sheet. It seems like Gann was either a transcendent genius tapping into profound universal truths previously unknown to the financial world, or maybe a brilliant marketer with an unparalleled knack for mystique, perhaps even self-promotion. But regardless of where you stand on the how or the why of his methods, his influence is just undeniable. His name is etched permanently into the history of financial analysis, and people across the globe continue to explore his theories, poring over his charts, seeking to unlock their elusive secrets. For someone trying to unravel these complex systems today, what's the biggest challenge? Is it truly the inherent complexity, or is it more about finding reliable interpretations of his original, often allegorical writings that were perhaps meant to be understood only by a select few?
That's a perceptive question, and I'd say it's probably a combination of both. The inherent complexity is certainly a barrier. It requires deep dives into mathematics and historical cycles that most traders simply aren't equipped for or, frankly, interested in. But arguably, the biggest hurdle for modern learners is often the lack of clear, unambiguous instructions. Gann taught in a very different era, and he often communicated his deepest insights through allegories, or left out crucial connecting pieces in his published works, perhaps deliberately guarding his most potent secrets. So even with the foundational concepts, actually applying them consistently and successfully becomes a significant interpretive challenge. It's kind of like having all the ingredients for a really complex dish, but not the full recipe.
Gann's enduring legacy, from books to practical trading rules.
Okay, so beyond the complex angles and master charts, the spirals and the esoteric connections, Gann also left behind a real treasure trove of surprisingly practical wisdom. He was, to put it mildly, a prolific author, leaving a significant number of books and courses that outline not just his grand principles, but also his astute observations on market behavior and human psychology.
Indeed. This extensive body of work truly shows a relentless, lifelong pursuit of understanding the markets and an unwavering commitment to sharing his insights. Even if, as we discussed, some of them remained veiled in allegory or required incredibly complex calculations for those not fully initiated into his specific methods. It's a testament to his dedication, not just to the markets, but to the education of others who were willing to put in the effort.
And what a breadth of work it is. Just to give you a real sense of his productivity and the evolution of his thought over time, here are just a few of his key books and their publication years, spanning decades of his active career. Speculation, A Profitable Profession way back in 1910, Truth of the Stock Tape in 1923, Tunnel Through the Air in 1927. Now, this one is particularly famous and arguably his most mysterious. It's often seen as a coded novel, a work of fiction containing hidden market secrets and predictive insights woven directly into its narrative, truly unique in financial literature. Then there's Wall Street Stock Selector, 1930, New Stock Trend Detector, 1936, Face Facts America, 1940, which showed his broader thoughts on economics and society, How to Make Profits in Commodities, 1941, How to Make Profits Trading in Put and Call, also 1941, 45 Years in Wall Street in 1949, The Magic Word 1950, and W.D. Gann Economic Forecaster, published in 1954, just before his passing.
Yeah, this extensive bibliography doesn't just show his sheer productivity. It powerfully highlights his evolving understanding of the markets and his consistent, tireless effort to codify his findings for others. While the geometry, astronomy, and astrology might have represented his grand, overarching theory of universal market laws, these books contain the distilled, practical experience of a man who spent well over half a century deeply engaged with the financial markets, observing human behavior and price action day in and day out.
But perhaps one of his most accessible, widely cited, and frankly enduring contributions are his 28 trading rules. Now, these rules don't rely on complex angles or celestial alignments. They are, at their core, about discipline, psychology, and risk management. They feel incredibly modern, almost universal in their application to any form of speculative endeavor. Let's really dig into these because they offer surprisingly profound insights for anyone navigating the markets, even today, regardless of their belief in Gann's more esoteric methods. These 28 rules, meticulously crafted and refined based on Gann's extensive lifelong experience, offer incredibly practical guidance on how to avoid the most common pitfalls that plague traders, and crucially, how to cultivate a resilient, successful trading mindset. They represent a masterclass in market discipline, cutting directly through the noise to focus on what truly matters for long-term survival and prosperity in the volatile, unforgiving world of trading.
It's truly remarkable how many of these rules, penned so many decades ago, are still taught as fundamental, non-negotiable principles in virtually any reputable trading course or serious investment program today. They demonstrate Gann's profound understanding not just of market mechanics, but of human psychology and its inherent pitfalls. He clearly understood that the biggest obstacle for most traders is often themselves.
Absolutely. Let's maybe categorize them for clarity and then dive deep into some of the most impactful ones. Sound good?
Sounds great. Let's start with the basics. A, capital management and risk control.
First, and perhaps most crucially, is how you manage your money, your lifeblood in trading.
Exactly. Preserving your capital is absolutely paramount. Without it, you can't even stay in the game, let alone win it. It's rule number 1 for a reason.
Rule 1. Amount of capital to use. Divide your capital into 10 equal parts and never risk more than 1/10 of your capital on any one trade.
This specific fraction, 1/10 or 10%, isn't arbitrary. It's a carefully considered safety mechanism. It's about ensuring that no single trade, no matter how confident or sure you might feel about it, can ever wipe you out or even severely cripple your trading ability. It builds an incredible resilience, forcing you to think about the long game, about surviving multiple inevitable losses, rather than chasing a quick, high-stakes win that could potentially end your career. It is, unequivocally, the foundational principle of capital preservation.
Right. And it directly ties into Rule 3, never overtrade. This would be violating your capital rules.
This is a classic insidious trap, often fueled by either unchecked greed after some wins or nagging impatience during slow periods. Overtrading means taking positions that are simply too large for your available capital, or trading far too frequently without clear justification based on your system. It directly violates the spirit and letter of Rule 1. It's not just about adhering to a specific percentage. It's about establishing and rigidly sticking to a disciplined framework that prevents you from getting emotionally carried away and exposing yourself to an unacceptable amount of excessive risk. It protects you from yourself, really.
Okay, moving on to diversification, which might seem a bit counterintuitive sometimes in speculative trading, but Rule 8 says equal distribution of risk. Trade in 2 or 3 different commodities if possible. Avoid tying up all your capital in any one commodity.
Well, even in speculative trading, where focus is often lauded, diversification remains a vital risk management tool. It wisely acknowledges that not all markets move in the same direction at the same time, and that unexpected news or events can hit one commodity or stock particularly hard. If one trade goes south, you're not completely exposed. Your entire account isn't tethered to a single outcome. It's about spreading your bets intelligently across maybe non-correlated assets to mitigate the disproportionate impact of an adverse move in a single asset or market.
Makes sense. Then there's Rule 11, accumulate a surplus. After you have made a series of successful trades, put some money into a surplus account to be used only in emergency or in time of panic.
This is just prudent financial management, pure and simple, applied directly to trading. It's about creating a robust buffer, a crucial safety net for your trading capital. Markets can be incredibly brutal, and unexpected downturns, or panics as Gann calls them, are not just possibilities. They are inevitable certainties over a long enough timeline. Having a separate surplus means you're not forced to liquidate positions at unfavorable times simply to meet margin calls or cover living expenses. It also means, and this is key, you can be in a position to seize incredible opportunities that often arise precisely during those periods of extreme volatility and market distress when others are being forced out. It's like having an emergency fund specifically for your trading account, allowing you to remain solvent and flexible when things get tough.
Yeah, like dry powder for opportunities. And this ties into a fascinating psychological point that Gann clearly understood. Rule 24, avoid increasing your trading after a long period of success or a period of profitable trades.
Oh, this rule is a direct, brilliant counter to human hubris. After a winning streak, confidence can all too easily morph into overconfidence, leading traders to take on larger, ill-considered risks than they normally would. You start feeling invincible. Gann keenly warns against this expansion, knowing implicitly that success, if not managed with humility, can breed complacency and ultimately lead to significantly greater losses down the road. It's about maintaining a consistent, humble, and disciplined approach regardless of recent outcomes, understanding that past performance is absolutely no guarantee of future results. Markets change.
And the inverse of that, equally important, is Rule 27. Reduce trading after first loss, never increase.
Again, Gann directly tackles a deeply ingrained human psychological tendency here. When a trade goes against you, the natural inclination for many is to get even or try to make back the loss quickly by increasing their position size or taking more trades, essentially revenge trading. Gann, with profound sagacity, advises the precise opposite. Respond to losses with heightened caution, not aggression. Step back, reduce your size, maybe take a break. It's a crucial self-preservation mechanism that prevents a small, manageable loss from snowballing into a catastrophic one. It forces immediate introspection and a disciplined reevaluation of your strategy and the current market conditions, rather than an impulsive emotional reaction. B, risk mitigation and stop losses.
Okay, now let's talk about perhaps the single most fundamental rule for managing individual trades. The stop loss. If you ignore everything else, you ignore this at your peril, right?
If there's one non-negotiable, absolutely mandatory rule in trading, it is this one. Gann understood its life-saving importance implicitly.
Rule 2. Use stop loss orders. Always protect a trade when you make it with a stop loss order.
This cannot be stressed enough. And it's a lesson that is often learned the hard, painful way. A stop loss is quite literally your insurance policy against potentially unlimited losses. It cuts your losses quickly, systematically, and without emotion, preventing a small, manageable error in judgment or timing from becoming a massive, account-killing disaster. It takes emotion out of the equation at the point of maximum pain, ensuring you adhere to your predefined risk tolerance for every single trade you take. Gann considered it absolutely vital, and its importance remains undiminished today. If anything, it's even more critical in today's volatile markets.
And it's not just about cutting losses, but brilliantly about protecting gains, as in Rule 4. Never let a profit run into a loss. After you once have a profit, raise your stop-loss order so that you will have no loss of capital.
Yes, this is the essence of a trailing stop, or at least moving your stop to break even. Once a trade moves favorably in your direction and reaches a certain profit threshold, you systematically move your stop-loss order up for a long position or down for your short position to lock in at least some profit, or at minimum to ensure you don't lose capital on what was once a winning trade. It effectively turns a potential winner into a guaranteed non-loser, and then hopefully into a winner with a guaranteed minimum profit. It's a simple yet incredibly powerful way to secure your gains and systematically reduce your risk exposure as a trade progresses in your favor. Takes the pressure off.
This feeds into Rule 10. Don't close your trades without a good reason. Follow up with a stop-loss order to protect your profits.
This rule champions patience and the wisdom of allowing winning trades to fully develop and run their course while being protected. Many traders, driven by fear or impatience, cut their profits short, taking small gains only to watch the market continue significantly in their originally intended direction. Gann advises against this impulse, but crucially, he pairs it with the continuous, diligent use of a stop-loss. So you let your winners run, allowing them to maximize profit according to your system's exit rules, but you always have that protective safety net in place, continuously adjusting it, like in Rule 4, to protect what you've already gained. It beautifully balances patience with prudence.
And a critical, though I suspect often violated, rule, especially in moments of panic or hope. Rule 16. Never cancel a stop-loss order after you've placed it at the time you make a trade.
This is all about iron discipline, about integrity to your own trading plan. The very moment you place a trade, your maximum acceptable risk, your stop-loss level, should be unequivocally set based on your analysis. Canceling or moving a stop-loss further away, especially when the market is going against you and hitting your original level, is almost always an emotional, desperate decision fueled by hope. And it almost invariably leads to larger, often catastrophic losses. It's a betrayal of your own predefined plan and a testament to the dangerous power of hope over cold, hard logic. Gann understood that rigidly sticking to your plan, even when it feels painful in the short term to take that predetermined loss, is absolutely essential for long-term survival and success. See trend following and market timing.
Okay, moving on. Gann was incredibly clear on the paramount importance of understanding and aligning with the market's prevailing direction. The trend is your friend, as they say.
He absolutely believed that aligning with the prevailing force of the market was the key to success, not foolishly fighting against it like trying to swim against a strong current.
Which brings us to Rule 5. Do not buck the trend. Never buy or sell if you're not sure of the trend according to your charts and rules.
This is perhaps the most fundamental principle of market analysis and successful trading. Trading with the prevailing trend dramatically, exponentially, increases your probability of success. Trying to pick the exact bottoms in a strong downtrend or the precise tops in a raging uptrend is a notoriously low probability, incredibly high-risk endeavor that has bankrupted countless traders over the years. Gann unequivocally advises clarity and absolute conviction about the trend before entering any position. If you're unsure if the trend isn't obvious according to your defined rules and time frame, you simply stay out. Patience is absolutely key here.
Which naturally brings us to Rule 6. When in doubt, get out, and don't get in when in doubt.
Simplicity itself, yet profoundly powerful advice. If you lack conviction, if the market isn't presenting a crystal clear opportunity according to your established rules, then the wisest course of action is simply to avoid taking action altogether. Stay flat. Uncertainty breeds bad decisions, almost without fail. This rule serves as a powerful shield, saving you from unnecessary losses due to speculative, unconfirmed, or simply ill-conceived trades made out of boredom or fear of missing out. It's about patiently waiting for high-probability setups to emerge, rather than forcing trades when the conditions aren't right.
And Rule 7. Trade only in active markets. Keep out of slow, dead ones.
Yeah, this speaks directly to the concepts of liquidity and opportunity. Active markets have sufficient trading volume and volatility to allow for profitable movements and critically efficient entry and exit at desired prices without significant slippage. Slow or dead markets, on the other hand, can easily trap your capital, offer incredibly limited profit potential, have wide bid-ask spreads, and make it exceptionally difficult to execute trades at favorable prices, sometimes leaving you stuck in a position you can't easily exit. You generally want to be where the action is, where there's sufficient momentum and liquidity to support your trades.
And here's a powerful emotional rule that really speaks to the human condition, Rule 14. Never get out of the market just because you have lost patience, or get into the market because you are anxious from waiting.
This addresses two incredibly common and destructive emotional pitfalls: impulsivity and fatigue, or FOMO. Impatience can lead you to prematurely exit potentially profitable trades long before they hit their target, just because it's moving slowly. Or, equally damaging, it can cause you to enter trades prematurely before your setup is fully confirmed, just because you're tired of waiting. Anxiety stemming from waiting, or that pervasive fear of missing out when you see others making money, can push you into trades out of sheer boredom or a desperate need to be in the action. Gann's profound wisdom here is all about emotional discipline, letting your well-defined rules dictate your actions, not your fleeting, often irrational feelings of the moment.
Gann also wasn't limited to just one side of the market, which was quite advanced for his time. Rule 18. Be just as willing to sell short as you are to buy. Let your object be to keep with the trend and make money.
This is absolutely crucial for being able to profit in all market conditions, not just during bull markets when everything seems to be going up. Many new traders are only comfortable buying long, which severely limits their opportunities to only periods of rising prices. Gann astutely emphasizes that the ultimate goal is simply to make money by diligently following the trend, whether that trend is moving decisively up or definitively down. Being willing and able to sell short allows you to capitalize on downtrends and effectively double your market opportunities, greatly expanding your potential for profit over the long run.
And a big one, especially for inexperienced traders trying to catch falling knives. Rule 19. Never buy just because the price of a commodity is low, or sell short just because the price is high.
Right. This rule delivers a vital warning against what are often called value traps, or the perilous act of prematurely calling market tops and bottoms based solely on how high or low the price looks historically. A price that appears low can, and often does, get even lower, much to the chagrin of those trying to buy the dip in a persistent downtrend. Similarly, a price that seems high can, propelled by strong momentum, continue to climb much higher than anyone expects. Think bubbles. Gann's unwavering focus was always on the trend and confirmed market structure, not just absolute price levels. He advocates waiting for clear confirmation of a trend reversal or continuation before acting, rather than speculating solely on price extremes based on gut feeling or how cheap expensive something appears.
Finally, a powerful statement on trusting your systematic approach over your gut feeling or predictions. Rule 25. Don't guess when the market is top. Don't guess when the market is bottom. Let the market prove it is top. Let the market prove it is bottom. By following definite rules, you can do this.
This rule powerfully reinforces the importance of empirical observation over mere speculation or prediction. It's a testament to the profound effectiveness of having a rules-based system. Instead of relying on intuition, hope, ego, or a subjective feeling about where the market should go, you patiently wait for your predefined criteria for a top or bottom to actually be met, for the market itself to give you a clear, objective signal that a reversal or continuation is genuinely underway. It systematically removes emotion and personal bias from critical turning point decisions, relying instead on the undeniable objective evidence presented by the market itself through price action and your indicators. This removes so much guesswork and ego. D. Avoiding common trading pitfalls. Okay, moving on to specific behavioral traps and tactical errors that Gann observed traders consistently, almost habitually make. These are the subtle dangers that can often erode even well-earned profits over time.
Exactly. These are the deeply ingrained habits and psychological biases that frequently sabotage traders, even those who might have otherwise sound market ideas or strategies. The execution and mindset pitfalls. Like Rule 9. Never limit your orders or fix a buying or selling price. Trade at the market.
Yeah, this rule emphasizes the critical importance of execution, especially in fast-moving, volatile markets where prices can gap or run away quickly. Trying to get a perfectly precise price with a limit order, or insisting on a fixed entry or exit point down to the last tick, can often mean missing the desired move entirely, because the market simply never touches your exact price or blows right through it. Gann suggests that once you make the disciplined decision to enter or exit a trade based on your rules, you do it decisively, taking the prevailing market price, using a market order, While modern trading systems offer more sophisticated order types like stop limit orders, the core message remains. Don't let a few ticks or an attempt at absolute perfection prevent you from participating in a confirmed move or getting out when your stop is hit. Get in or get out, then manage the trade.
Okay, and Rule 12. Never buy or sell just to get a scalping profit.
This advises against focusing solely on tiny, high-frequency, low-profit trades. While scalping is a valid and often profitable strategy for some highly specialized traders with the right tools and mindset, Gann's rules generally lean towards capturing more meaningful, substantial moves in the market trend following or swing trading. Constant small entries and exits can rapidly rack up excessive transaction costs, commissions, slippage, fees, and lead to significant emotional fatigue, all without necessarily delivering substantial net gains relative to the effort and risk. He suggests focusing your energy on trades with more room to run, with potentially better risk-reward profiles inherent in larger market swings.
Now, this next one is absolutely critical and perhaps the most dangerous mistake a trader can make, as you mentioned earlier. Rule 13, never average a loss. This is one of the worst mistakes a trader can make.
This is, without a shadow of a doubt, one of the deadliest sins in trading. Averaging down a losing position means systematically buying more of an asset that is moving against you, effectively multiplying your exposure to a losing trade. It's often a desperate, emotional attempt to lower your average cost basis and get even on a trade that went wrong, fueled by ego and the inability to accept being wrong. But it almost invariably leads to catastrophic losses as the market continues its adverse trend, because trends often persist longer than you think. Gann, in his profound wisdom, understood that admitting you're wrong early and cutting the loss quickly, using your stop loss from Rule 2, is always vastly superior to digging yourself into a deeper, potentially inescapable financial hole. And let's be honest, this is probably the rule every single trader, myself included, has been tempted to break at some point. It's that powerful psychological pull, that hope that if you just put a little more capital in, it has to turn around eventually. But Gann, in his wisdom, saw this as the ultimate form of self-sabotage.
Oh, absolutely. The hope trade is a truly dangerous one. And the inverse of Rule 4 we discussed earlier about protecting profits is equally important. Rule 15, avoid taking small profits and big losses.
Yes, this rule is all about ensuring asymmetric risk-reward, which is absolutely fundamental to long-term profitability in any probabilistic endeavor like trading. You fundamentally need your winning trades, on average, to be significantly larger than your losing trades to overcome the fact that you won't win every time. Many traders make the classic mistake of cutting their winners short out of fear of giving back profits or impatience, while simultaneously foolishly letting their losers run far past their initial stop loss in desperate hopes of a turnaround, violating Rule 13 and Rule 16. This creates a negative expectancy, a losing probability profile where even if you win, say, 60% or 70% of your trades, your net result can still be negative because the losses are so much larger than the wins. Gann teaches you to let winners run, diligently protected with trailing stops, as per Rule 4 and 10, and cut losers swiftly and decisively, Rule 2, ensuring your overall profitability is driven by those large wins, not small, fleeting profits.
Makes perfect sense. What about Rule 17? Avoid getting in and out of the market too often? Seems related to Rule 12 on scalping.
It is related, but it also addresses the broader problem of overtrading or churning your account, even if you're not strictly scalping. Constant activity, jumping from one idea to the next without letting trades develop, leads to excessive transaction costs, commissions, fees, slippage that rapidly eat into any potential profits, even if your underlying strategy is sound. But perhaps more importantly, it leads to significant emotional fatigue, a tendency to chase every small market fluctuation, and often making impulsive decisions born of boredom or an insatiable need to be doing something active in the market. Gann strongly encourages a more measured, patient approach, waiting for clear, high-probability signals according to your rules, rather than engaging in constant low-quality activity that just generates costs and stress.
Okay. Now, pyramiding is a technique to increase position size as a trade moves favorably, but Gann had specific, crucial advice for it. Rule 20. Be careful about pyramiding at the wrong time. Wait until the commodity is very active and has crossed resistance levels before buying more, and until it is broken out of the zone of distribution before selling more.
Exactly. Pyramiding can be an incredibly profitable strategy to maximize gains on strong trends if executed correctly. But it can be absolutely disastrous if done wrong, as it increases your average entry price and concentrates risk. Gann wisely advises pyramiding into strength, meaning you only add to a winning position when it's clearly demonstrating renewed momentum, breaking out through significant resistance levels for longs, or support levels distribution zones for shorts. You add when the market is powerfully confirming your initial conviction, not when it's consolidating, pulling back significantly, struggling, or showing signs of doubt. It's about reinforcing a conviction that the market is truly moving decisively in your favor, and doing so only after concrete confirmation from price action itself. You're adding fuel to a fire that's already burning strongly.
Which is further clarified by Rule 21. Select the commodities that show strong uptrend to pyramid on the buying side and the ones that show definite downtrend to sell short.
Yes. This powerfully reinforces the idea of pyramiding only with the dominant trend. You are adding to positions that are already proving themselves winners and moving in a clear, undeniable direction in assets that are leading the market. It's not about buying dips in a downtrend, hoping for a reversal, or selling rallies in an uptrend, trying to pick a top and then adding more if it keeps going against you, which would violate Rule 13. It's about identifying the strongest trends and riding and maximizing the confirmed momentum of the market by adding to your exposure in those specific leading instruments. You are adding to your strongest positions, not your weakest ones.
And a clear, perhaps counterintuitive stance for some on a common but often misguided strategy. Rule 22. Never hedge. If you are long of one commodity and it starts to go down, do not sell another commodity short to hedge it. Get out of the market, take your loss, and wait for another opportunity.
Gann advocates for absolute simplicity and crystal clear strategy, especially for individual traders. Hedging, for many retail traders, often just adds a layer of complexity that paradoxically obscures existing losses and makes it much harder to assess true performance and risk. You end up with two positions, potentially both losing or canceling each other out while racking up costs. Instead of trying to offset a losing position in one market by taking an opposing position in another, which might even be correlated, Gann's blunt, direct advice is to just admit the loss in the initial trade, close it decisively according to your stop-loss rule, take the hit, learn from it, and move on to find the next high-probability opportunity. It's about maintaining a clear, direct, and unambiguous strategy, and not trying to hide or complicate mistakes behind intricate, often confusing maneuvers that just delay the inevitable reckoning.
Discipline extends even to conviction once you're in a trade. Rule 23. Never change your position in the market without a good reason. When you make a trade, let it be for some good reason or according to some definite rule. Then do not get out without a definite indication of a change in trend.
This rule is all about sticking to your predefined plan and avoiding arbitrary or emotionally driven decisions after you've entered. Every single entry should have a clear, logical reason based on your system. And every single exit should also have a clear, logical reason, either hitting your profit target, your trailing stop, or a signal indicating the trend has reversed according to your rules. It directly prevents impulsive reversals based on noise or fear, ensures that your actions are deliberate, well-considered, and consistently aligned with your overall strategy from start to finish. It's about maintaining unwavering consistency in your approach and trusting the process.
And a timeless piece of advice that applies far beyond trading into almost any area of life where advice is given. Rule 26. Do not follow another man's advice unless you know that he knows more than you do.
This is such a powerful call for personal accountability, critical thinking, and intellectual independence. In today's world, saturated with gurus, conflicting opinions on social media, newsletters, and endless streams of financial advice, Gann stresses the paramount importance of validating sources, truly understanding the why behind any recommendation, and ultimately developing your own profound understanding of the markets through your own work and experience. Don't just blindly follow tips. Understand why someone is advising something, what their methodology is, and whether it aligns with your own risk tolerance and strategy. It champions self-reliance, rigorous due diligence, and the continuous essential process of building your own knowledge base and conviction.
Finally, a kind of meta rule about understanding your own errors in the process. Rule 28. Avoid getting in wrong and out wrong. Getting in right and out wrong. This is making double mistakes.
Yeah, this rule succinctly emphasizes the critical importance of both the entry decision and the exit decision in every single trade. They're equally important. Getting the entry wrong is one mistake, compounding it by then getting the exit wrong. Example, panicking and exiting at the absolute worst possible point, confirming a larger loss than necessary, or holding on too long is a double error. Conversely, getting the entry right but then mismanaging the exit, example, taking profits too soon or letting a winner turn into a loser, is also a costly error. It pushes you to reflect deeply on both phases of a trade, the entry, management, and the exit, to learn from every experience, win or lose, ensuring you don't repeat fundamental errors at these critical junctures. It's a powerful framework for continuous improvement and refining your execution.
So, what does this all mean for us today? These rules, though written decades ago in a vastly different market environment, seem incredibly, almost startlingly relevant for anyone navigating today's high-speed, complex global markets, regardless of their technical prowess or their belief in Gann's more esoteric methods. They cut directly to the core of sound financial practice and timeless human psychology.
Absolutely, and this raises an important question. Beyond the specific tactical advice contained in each rule, what's the overarching message Gann conveys through this powerful set of 28 principles? It's a deep, unwavering emphasis on discipline, meticulous self-analysis, and, crucially, a commitment to relentless learning from every single trade, especially the losing ones. He understood, perhaps better than almost anyone before or since, that true, sustainable success in markets isn't just about finding the perfect entry point or having a secret forecasting method. It's fundamentally about diligently managing risk, maintaining unwavering emotional control under pressure, and continuously refining your approach based on real-world feedback and honest self-assessment. And Gann himself reinforces his profound insight with his final advice on these rules, a piece of wisdom that applies to much more than just trading commodities or stocks. When you close a trade with a loss, go over these rules and see which rule you have violated. Then do not make the same mistake the second time. Experience and investigation will convince you of the value of these rules, and observation and study will lead you to a correct and practical theory for successful trading.
That's the ultimate meta rule, isn't it? Continuous learning and diligent self-correction based on your own mistakes. It's not just about intellectually knowing the rules, like memorizing them. It's about actively, rigorously applying them in real time, reflecting deeply and honestly on failures without making excuses, and using those reflections to systematically build a robust, successful strategy and mindset over time. It's about transforming every single misstep into a valuable stepping stone towards mastery. Outro.
Wow.
So, from a self-taught farmer son in rural Texas, drawing profound insights from, of all things, the Bible and ancient cultures, to a pioneering market analyst who completely captivated the financial world, W.D. Gann's legacy is truly multifaceted and deeply intriguing. We've journeyed through his enigmatic life, we've touched upon his complex methods rooted in geometry, astronomy, and ancient principles, and most importantly, we've delved deep into the timeless, surprisingly practical wisdom encapsulated in his 28 trading rules.
His enduring relevance, I think, lies precisely in that balance. While his more esoteric methods, the square of nine, the astrology remain controversial and certainly demand a lifetime of dedicated study to even begin to unravel properly. His foundational focus on iron discipline, meticulous risk management, and a profound understanding of market psychology continues to resonate deeply with traders and investors across generations. The ongoing fervent interest in his methods, as powerfully evidenced by resources like the Market Geometry Knowledge series we mentioned, available through the Market Geometry app, clearly shows that his relentless search for an underlying order and universal truth still captivates and challenges minds today. People are still trying to crack the Gann code. We've explored Gann's deep-seated belief that markets, like all natural phenomena, are governed by underlying natural laws, expressed through universal cycles and rhythms. This prompts maybe a final thought for you, our dedicated listener. If markets, and perhaps life itself, are indeed expressions of these universal cycles and rhythms, how might diligently observing the patterns in our own lives, our habits, our successes, our setbacks, our reactions to external events, offer profound insights into our personal market trends, so to speak?
That's a fascinating thought. It's about finding those recurring patterns in our own behavior, maybe understanding their underlying drivers, and perhaps applying the same relentless discipline Gann advocated for traders to our own endeavors, whatever they may be. So as you go about your week, whether you're analyzing a spreadsheet, making a significant personal decision, or just reflecting on your day's experiences, maybe consider, how are you consciously applying discipline in your own life? And perhaps even more importantly, how are you truly learning from every mistake, systematically turning it into invaluable experience, just as Gann advised his traders to do with those 28 rules? It's a remarkably powerful framework, really, to think about navigating any complex system, whether it's financial, professional, or indeed personal. Something to chew on.